and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm here today, joined by Ian Spreadbury, manager of the Money Builder Income Fund.
Hello, Emma.
Hello there. So you've been running bond funds for 20 years, with some success, it should be added. Money Builder Income is a gold-rated fund by Morningstar fund analysts. What do you say to the people, given that you have that long experience, who say that we're now in unprecedented times for bond investing, that we've never seen a market like this before?
It's true to some degree. When I launched Money Builder Income 20 years ago, yields were about 8%. They're now 3%. So over the last 20 years, we've seen great performance from bonds, and bonds have done a very good job as an equity diversifier. Over that period, equity performance has been pretty volatile. I do think, inevitably, given where yields are at the moment, that returns from bonds will be a bit lower going forward. But I'm very much in the slow growth, low inflation camp. And so I still think we can see decent bond returns going forward. And I think bonds should continue to do a good job in terms of being less volatile than some other asset classes like equities, being a good equity diversifier, and also throwing off, albeit a more modest level of income relative to cash, still not too bad.
I mean, fundamentals look as if that we're going to be in a low growth environment, not just for bonds, but for equities too. You know, the developed market equity run that we've seen over the last 5 years can't really continue indefinitely. One of the things that's threatening bonds in particular is the threat of an interest rate rise. I mean, are you worried about that? Is that something that's looming over the horizon, or is it just one of those things that headline grabbing?
I think it's something we'll likely see, but to some degree it's been discounted by the markets already. Again, I think the authorities are pretty concerned about this extraordinarily low interest rate environment. I think they're worried about the impact of ultra low interest rates and the QE that we've seen on the economy going forward. And so, for example, we've seen a widening in the wealth divide. We're in a situation where arguably poorer companies are being helped to stay afloat. And things like that are not necessarily good for the economy going forward. So I think they'd like to see rates going up a little bit. Growth and inflation have surprised on the downside pretty consistently over the last few years. And I think that may happen going forward. So I think they'd also like to build up some ammunition to hike rates a little bit, if only to have some firepower to cut them if growth and or inflation were to surprise on the downside going forward.
And are you still seeing ample opportunities, ample investment in the bond market? Because one of the sort of strange things that's happened over the last couple of years with the huge amount of QE that's been pumped into the system is there seems to have been a disconnect with some government bonds in particular between how risky a particular bond is and actually the yield that you can get on it. So with that in mind, are you finding opportunities, perhaps less than you were before, but going forward?
I think there are still opportunities in the bond market in various areas. I think you've got to remember that the long-term driver of high-quality bond yields is nominal growth. So I'm still very much in the low growth, low inflation camp. So corporate bond yields, 3.5% for BBB high quality bonds is actually not too bad, and I think it's in line with the economic environment, so I'm pretty happy. So I'm still finding decent opportunities. We had a recent deal for Center Parc, for example, a great credit, but on a yield of about 1.5% over and above government bonds. We recently had a deal for Imperial Tobacco in dollars, for example, again on a yield of about 2% over government bonds. So in corporate bonds there are opportunities. I mean, I guess to a lesser extent in government bonds. I think there may be some opportunities in emerging markets, but I'm pretty cautious. And certainly our Money Builder Income Fund is very much focused on investment grade rather than high yield.
And then putting your high yield to one side, then looking at investment grade, when we have economic growth, when we have improving economic outlooks, we often see an uptick in M&A, and that is both a positive thing for equity investors, but it is a positive thing for bond market investors as well. Is that something that you're looking to take advantage of?
It can be positive. For example, when Verizon took over Vodafone's mobile assets last year, they issued, I think, what was the largest ever corporate bond deal. I think they issued 49 billion in one day, but they had to pay up for that. So as an investor, we had the benefit of that higher yield. It can be a negative if a company leverages and, if you're already in the bond. But, that's our job at Fidelity, really, to be on the right side of that leveraging.
And just taking a minute about diversification, because you did say at the beginning that bonds play an important role in diversifying from equities within an investor's portfolio, which of course they do. Wherever the opportunity set is, you should always have diversified asset allocation. What about then diversification within the fund? Because you have talked in the past about the importance of holding a cash buffer for that reason.
I think it's important to diversify to get the right risk-return balance and to avoid being over-concentrated in the fund. For example, at the bond level in investment-grade bonds, arguably risk is asymmetric. So if a company goes bust, you could lose everything. But on the other side, if things go well, you clip your coupon and the capital upside is pretty limited. So in bonds, it's incredibly important to diversify. So the largest holding in my investment grade portfolios would be, say, 3% of the portfolio. Also at the sector level, for similar reasons, it's important to diversify. So I am pretty diversified. I am quite worried about the economic environment. Again, I think we've got this massive structural debt problem globally that I think is bearing down on growth. And so, there is a downside risk. And I am very much focused on high conviction companies, bonds with asset backing, bonds in areas like regulated utilities, non-cyclical, food, drink and tobacco type sectors. And it is important to diversify.
The safest of the safer assets?
Well, it's always a balance between getting paid and safety and getting that right risk-reward balance, and that's what I'm trying to do in the fund.
Ian, thank you very much.
Pleasure.
This is Emma Wall for Morningstar. Thank you for watching.